Welcome to PhillipCapital Weekly Market Watch. I'm Lin Sin from Unit Trust Research. Today, we would like to share some thoughts on Japan's recent sales tax hike and what to expect in near future. The Japanese economy has gathered steam over the last year, following Prime Minister Shinzo Abe's economy policies, also dubbed as the Three Arrows, which consists of fiscal policy, monetary policy, and structural change. The unprecedented aggressive monetary easing, a key leg of Abenomics, aimed to spur inflation and cut borrowing costs for Japanese finance companies. It's nudging the nation out of the cycle of falling prices while rising proclivity to spend. On April 1, the value-added tax, VAT, or also known as Goods and Service Tax, GST, in some countries or in Singapore's context, is set to rise 3 percentage points from 5% to 8%, the first increase since 1997, and is envisaged to inflate cost of living, which is already at 5-year high, in addition to the squeeze on Japanese households amid stagnant wages. The tax hike is deemed as a crucial step to help stabilize government finances amid swelling current account deficit and government debt. However, the double-edged sword aimed to broaden the tax base and cover the increasing social security expenses is also posed as a possible setback to economic recovery. So, is it 1997 all over again? Some investors draw a parallel to 1997, when Japanese economy spiraled into recession after raising its sales tax to 5% from 3%. Concerned on whether the economy will once again be dragged down by the sales tax hike. However, a lot has changed since then. 1. Back then, it was against the backdrop of Asian financial crisis, when the Japanese financial sector was insolvent and corporates' ability to withstand shocks was low. However, this is not the case now, as both the financial sectors and corporate have strengthened their balance sheet and financial position after a series of restructuring and deleveraging. 2. Government has put in place measures to mitigate its economic impact. In December 2013, the government formalized a 5.5 trillion yen economic stimulus package to help offset the shorter-term effects that the consumption tax rate increase may have on the economy. Additionally, the government will lower the effective corporate tax rate by 2.4 percentage points in April 2014, from 38% to 35.6%, with potential reductions later. This cut is anticipated to assist with improving corporate profitability, which may translate to higher employee wages amid a tightening labor market. Nevertheless, this year's sales tax hike may cause some short-term impact on the headline numbers in both pre- and post-tax hike environments. 1. In economic activities, the increase in the consumption tax rate is already contributing to data volatility prior to April 1st. Ahead and in anticipation of the tax hike, many Japanese consumers tend to bring forward expenditures and then cutting back sharply, particularly on larger items, after the tax increase is implemented. The decision is to purchase now than later, as the higher levy will erode the real purchasing power of household nominal income. The economy now has to absorb the downside phase of fiscal policy. Household spending fell for the first time in 6 months, and retail sales growth slowed in February. Number 2, in consumer price index, the inflation numbers will be similarly distorted. Consumer prices rose 1.5% in February from a year ago, near the 5-year high of 1.6% gain in December. Meanwhile, core CPI rose 1.3% in February, marking the 9th straight month of on-year increases. The Bank of Japan, BOJ, estimates that the tax increase will add about 2% to prices in May. When combined with the underlying core inflation in February, inflation will exceed 3% for the first time since 1991. Initially, inflation rate was driven by a weaker yen, which was directly impacted through higher import costs. The yen plunged 22.24% against USD last year, the sharpest drop since 1979. If the yen stabilizes at a certain level, core inflation will start tailing off again in the future. Therefore, we may see core CPI to peak around April and to ease gradually throughout the second half of this year. Number 3, in labour market. Perhaps the labour market is a better place to continue to focus than the noisy data where the distortion will be less evident. The country's unemployment rate improved to 3.6% in February, the same level recorded in August 2007, and marking its lowest since 1998. We see strength remains one way. The number of jobless declined for the 45th straight months in February, as clear signs of tightness continue to mount. If price gain outpace wage growth, the higher levy will cut into consumers' purchasing power and hence increasing headwinds to economy recovery. Nonetheless, the tightening labour market could support wage growth in months ahead, relieving some of the pressure of households. Number 4, in business sentiment. Sentiment among large Japanese manufacturers rose to the highest level since 2007, a quarterly BOJ report showed. The Tankan Index, a survey of 10,483 businesses, climbed to 17 in March from 16 in December. However, the gain may be short-lived as higher levy on this month weighs on consumption and confidence. The sales tax hike may tip the world's third largest economy to its first contraction and may even be its deepest one-quarter economic contraction in more than a year, in the April to June quarter, led by a sharp fall off in consumption. Gross domestic product could shrink 3.5% in this quarter ending June, according to the median estimate of economic survey by Bloomberg. However, the contraction is likely to be temporary as the government will front-load budget spending for the year from April 1st to cushion the blow from the higher levy, and the BOJ has signaled that it's ready to boost easing if needed. Government pledged to speed up deployment of government cash in coming months on the back of the surprise drop in February's consumer spending. Meanwhile, Japan's industrial production for February slipped 2% from the previous month due to heavy snowfall and slowing demand for construction-related products. We also add pressure for the BOJ to pursue additional monetary easing. With overseas economies continue to gain traction, along with the weaker yen, Japan's export is poised to improve and providing tailwind to the Japanese economy, thus taking up the slack from the sales tax hike and avoiding the need for additional monetary policy. We believe that market prices have already discounted these issues as the tax hike is well known by the market. Until the second round of the two-stage tax hike, which is to increase sales tax to 10% in October 2015, it remains to be seen if the tax hike will derail Abenomics and leave stores empty. And it is unpredictable on how deep and prolonged the decline will be. At the moment, all eyes are on the upcoming April 7 to 8 policy meeting. Hence, at the meantime, investors may wish to ride on the wave of market overreactions and focus on fundamentals while bracing for the blow. This is all we have for you today. I'm Lin Sin from Phillip Unit Trust. Tune in for more Market Watch videos. Thank you.